Hey everybody, Brian here from quantlabs.net. Okay, so I've been going through all the statistical arbitrage with financial economics. I can never say this word. Econometrics. Basically what we're doing in the term of quant. This presentation is very, very useful as a demo to show you what can be done with all these different types of models and stuff. But since I just added a new section of downloads on my Academy, right here, you just do a search on statistical arbitrage or something. This is a new document I've just uploaded, which I'm going to show you in a second. I want you to take a look at this because this is a very powerful presentation. So basically, it's from somebody at NYU. It could be a student. It's some course intro. So essentially, what we're doing here is we're doing exactly this, where we're doing programming in C or C++, specifically, I'll say C#, some C++, maybe more C++. Later on, MATLAB, we also played with R, blah, 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 what we're looking for. I just want to show you the quick chart. So let's say you have your time series here. You're trying to determine ways to forecast which way the market's going to go. There's different methodologies here. So as this demo, this presentation showcases, there's three ways of doing it. You do it through fundamental analysis, technical analysis, or quantitative analysis. That's what we focus on here at quantlabs.net. Thus we call it quant. So basically you have your pricing, all your different pricing action. You get all these really cool little notation here, mean, standard deviation, which this kind of explains it. It looks daunting, but believe me, it's not. Hey, I'm a preschooler, mathematical type of person, so if I get it, most people can kind of get it. So of course, different states that you look at, you may understand the stochastic process, which will generate something like this. Then you get obviously your time series and your different movements of X, 2, 3, that sort of thing, and then you get your forecasting, which is right here in yellow. We want to know what direction we're going in. And of course, there's different views of it as well. This is very typical what you'd see in MATLAB in a nutshell, where you can do these scatter plots, and you're trying to determine a general pattern within this noise of the scatter plot, which is from this to this. Now again, I'm just showing you the very basics of it, so you can kind of have an idea. And then of course there's things like auto covariance, which we use in MATLAB. Then you get your representation of your threshold of some kind of range that you set, or that maybe this model or calculation will set. And once it steps outside of this range, you know something is definitely going on, which can, depending upon what you're doing and how you're calculating, could be a trading decision, right? So then we look for stationary data using all these different mathematical techniques. You can also get an idea of how fast the curve is sloping. So that might mean more volatility, or factor variant, or of volume could affect that. So there's a lot of these different equations that are built around this. And of course, we're looking for a stationary process of mean reversion. I've just done some examples of mean reversion. Again, coming back to Ernie Chan, that's what drives a lot of his profits in his business, in his quant business. So what we're looking at, this is an interesting set of charts I've never really looked at. So you have a non-stationary process, a stationary process, which is obviously flatlining, but there's a non-stationary, meaning it's up or down. So in the world of trading, you have it's just really flatline. It's not really going anywhere. So it's where the mean reversion comes in, where you are trying to see if the mean of that direction, as it's like basically hovering around, if it's going to go back to the mean. So that's basically what it means. And of course, you do your time series analysis. There's different techniques to look for it. Then we look for different factors known as white noise. It could be a lot of things. which is usually in the epsilon Greek symbol, which is, I don't think it's here. This is a standard deviation, or your volatility is a common one, but it can mean different things. So when you're looking at your equations, you have your returns, you have your standard deviation, and there's different ways to manipulate it. Both MATLAB and R focus on that, but specifically when you start drilling into your MATLAB, in my case, you'll see a lot of this, and you'll understand the movements and the importance of these, the flow of the data and the ticks, and it will show basically patterns, and that's what we're looking at. So this ID independence, and I can't remember independence, and but it's a very common term. And of course, as I said, we have the white noise. Of course, I'm just giving you my view of it, and there's different ways of attacking it. But as I look through it, I'm no expert by it by any means, but I just wanted to walk you through this. And again, there's another process you can go through, random walk. These are all the conditions that you need to have that make it a random walk, but this is your typical charting patterns that you can get, this sort of thing. And again, the scatter plot is widely used, and these are all the different paths on which this could go. And then you have this, it's a very simple process. Like, these notations is very simple. For example, you have your S1, or your time, your iterative, I can't remember the name of this. Goddamn, I'm always jumping around. But it's like a for loop, basically starting at j equaling 1 to t, and then multiply some kind of x, where x is meeting this condition. I'm sure this will come back to me. But from a programming standpoint, it's all the same. Okay, so then we have our moving average process. Of course, moving average, or MACDs, typical, or MA, simple moving average, exponential moving average. Again, this charting is very similar. It could be measuring the magnitude of that moving average, or again, the scatter plot, looking at the outliers of the scatter plot. Again, is it stationary? So we're looking for those type of patterns, and we look at autoregressive patterns. Same idea, different calculation, different calculation, different calculation, but they're all the same. But again, it's just the measurement, the different patterns, as well as the scatter plot. Again, is it stationary? This is just the building blocks of basically financial models. That's why I'm choosing this presentation. Is it random walk, autoregressive? Autoregressive is the same thing as Riemann. I've also shown that. Now, I've not gone into the decomposition of any of this at all. So again, you have the different components that can affect the movement. Seasonal, stationary, and then of course the trend on your volume. Again, I'm just guessing on that, but I'm just trying to give you my thought process on how this all works. These are all the different notations and different ways to decompose. So again, you can see that this is your typical pricing pattern, and yeah, you can see a general curve come from it, and that's where your general model may come from. And then you can get some kind of calculation from it, and that's what we're doing. And then of course we're trying to measure that amplitude as well. And then of course we start doing our forecast based on that, and that's what we do with the modeling on a lot of this, with the different calculations and stuff that we use. So you can get a general idea if there's going to be a downward movement or an upward movement, all this stuff. Pretty simple. And then this is a really good one, where you start doing the Monte Carlo and you run the different simulations on the different pricing patterns and which way it will move. You see a lot of that, and you can do a distribution on it to normalize it, and you can start applying some statistical sort of stuff on it. So this is where all that comes into play. So in all, this is the general flow of generating your forecasting on how you do it. This document really gets into it, and it gives you a really general idea of how building models and using something like quant really helps. So I'm hoping that this really is useful for somebody, and I did really like this presentation. Again, it's available on my downloads section. Here, this is just look for financial econometrics and statistical arbitrage, and you should find it. I'll actually put that on there. Okay, so hopefully that'll help you out. Talk to you later.